Good afternoon. You're watching AB Live, a news-based chat show in which we discuss topics ranging from news, business, politics, and so much more. On today's episode, we are discussing the Middle East oil industry, and for that in the studios, we have Yorgos Bellaris and Edward Bell. Thank you so much for joining us.
Thank you.
Right, so Edward, let's start with you. So you are in charge of the commodities and the commodities market essentially, and your role is that of a commodity analyst. So can you tell us more about that, your role?
Yeah, absolutely. So I'm responsible for commodity market coverage at Emirates NBD, one of the leading banking groups here in Dubai and in the Middle East region. And under that, look after the entire commodity complex from energy, industrial metals, and precious metals.
Right, and Yorgos, Refinitiv. Tell us more about Refinitiv and the role in the MENA region.
Yeah, myself, I manage a team of analysts looking primarily on the shipping sector of the oil market. We have real-time coverage of the global fleet of tankers, so therefore we generate real-time analytics on the trade of oil, and we're in a position to tell almost live about the actual balances of supply-demand in the market.
Oh, great. So, well, I'm sure the last few months have been very busy for you considering what's been happening across the route. So, if you just want to touch up on that, what we saw recently with regards to the attacks that we saw in the Gulf of Oman, Strait of Hormuz, etc. So, were you able to monitor that as and when it was happening?
Yes. I mean, it was interesting developments. I mean, the last 2-3 months have seen quite a bit of activity. There's been bombings, there's been arrestings and seizures of vessels, there's been what one side calls as harassment of vessels, all of this in a very short time frame. Obviously Iran is on one side of this equation with the seizure of the tanker Stena Impero, which appears to be, and it's claimed to be by the British side as just a tit for tat for the seizure of the Grace 1 tanker in Gibraltar earlier in the month.
Right, but it's not just Iran, the US, UK that is affected. There is a global implication to all of these attacks. Tell us more about that.
Yeah, no, indeed, definitely. I mean, the Strait of Hormuz is a gateway towards the entire planet when it comes to oil supplies. More than 1/3 of the seaborne crude is exported through Hormuz. We're talking something around 15 million barrels a day, cumulatively speaking, from Iran, Iraq, Kuwait, Saudi, Qatar, and part of the UAE. Not all of the crude is exported from within the Gulf from the UAE. Part of it is exported from Fujairah. So definitely very significant. Buyers range primarily in Asia. A lot of the Asian countries are getting their oil from the Middle East. As of the last few years, not so much in the West as it used to be. I mean, the US has decreased its dependency on Middle Eastern crude. That said, it hasn't eliminated it, as I think was alluded in the media recently. There's still some dependency on Middle Eastern crude. And of course, we've got Europe that still relies to a fair amount in the Middle East for its crude supplies.
Right, great. Edward, coming to you now. So after these attacks, we did see a sudden surge in the prices, and then it came down again just that weekend, etc. So on a macroeconomical level, so what are the direct impacts that this have had on this region?
Well, certainly the impact on pricing that we've seen from let's say the escalation of geopolitical tension related to the Strait and the Middle East more generally actually hasn't been that significant in terms of the pricing. It hasn't necessarily changed the outlook. And I think unless there's really a transformation in the way that all that crude that flows out from the Strait and the natural gas and products come out from the Strait of Hormuz is changed significantly, in terms of coming out via convoys or being disrupted for a prolonged period of time, we're probably not going to see that impact in terms of an upward move in prices. So from a point of view of the region, which still extracts a huge amount of its fiscal receipts and export revenues from the export of crude oil, it hasn't been that much of a game changer at this stage. And I think what it's showing is that the oil market is reflecting a lot more dynamics beyond just the geopolitical tension that we have in the Middle East currently. I think certainly issues around the performance of the global economy and simply are we going to need any extra crude going into the second half or in the second half of 2019 and into 2020, and other factors with the Middle East is still a very crucial supplier of crude to a lot of markets, particularly the Asian markets, but it's not the only one.
Right.
The transformation we've seen in the oil industry in the last, say, 10 years with new suppliers, and also energy efficiency, crude oil consumption efficiency in markets means that the Middle East is not as crucial as it might have been, say, 10 to 15 years ago in terms of its impact. Not to say that it's not important, but it's just a little bit relatively less important than it had been.
Right, so what then needs to be done to sort of be prominent or remain prominent in this market where the demand is definitely increasing, but the supply and suppliers, like you mentioned, is increasing at a higher level then?
Well, I think for the region as a whole, obviously we've seen major announcements from big economies to try and transition their economies away from being so heavily reliant on oil and gas receipts as a source of fiscal income. Here in the UAE, we've seen the introduction, and in Saudi Arabia, we've seen things like the introduction of VAT, which really probably would have been unthinkable 5 to 10 years ago, that you would have an indirect tax imposed on people in the countries. But it is showing an area where governments are exploring new ways of sourcing revenue. Also, the explosion and the increase in offshore borrowing, so borrowing in dollars or looking to borrow in euros from countries which traditionally hadn't been major issuers in terms of the Eurobond market. So these are other ways for the economies to try, or the governments to try and raise income. But I think in terms of still being important for the oil industry, obviously you have a base of resources here in the Middle East region that is readily available, also very low cost availability in terms of actually producing the crude oil. And governments have taken various steps by country in terms of trying to see other parts of the value chain, so investing into refining in a big way. So we've got some very large refinery projects in Saudi Arabia as well as here in the UAE, and also looking even further downstream into petrochemicals. Now these help you extract sort of more value out of per barrel, dollar per barrel of the crude market, but they don't necessarily translate into a transformation of the economy away from still being commodity dependent.
Right, okay, sorry.
That said, I think the key is the longevity that the Middle East has in the industry. I mean, the reserves are vast, and the projections can show that the production can stay quite high for many years to come. Not the case with the newer capacity or newer production of oil that we've been seeing in the last few years. For example, in the US, the very nature of this way of producing crude is different, and the shale processes are different, and it means that one needs to keep drilling sort of non-stop in a way if one wants to continually increase production.
But even with that, so there was sort of an excitement when they figured out the technology with regards to shale, etc., which is why they started supplying more than that was necessary, and then that sort of had an implication in this region. So would you say that right now there's an OPEC strategy and there's a shale strategy? Who's doing it better?
I don't think we can say there's a shale strategy. I mean, these producers obviously see a window for profit, and they just go after it. Obviously, a lot of elements came into place in the earlier parts of the decade. Higher oil prices supported their activity. Technology improvements helped them combine horizontal drilling and fracking and all that. So, in a way, a lot of things kind of unlocked these reserves that were not available previously. These tight oil formations. And obviously, this then becomes a cumulative action of many producers. There's really no strategy there. I think the only strategy when it comes to shale is chasing the profit, really.
Yeah.
I guess for OPEC is a little bit different. Traditionally has been different. OPEC is seen as the entity that regulates the market. Obviously, it's in the interest of everyone in this industry, including the governments, to have stability on oil prices, and this has been the role of OPEC, to keep prices as stable as possible to the desired levels, of course.
Right, so I need to ask you this right now, and probably I'll ask you this, Edward. So OPEC has been going out and saying that our aim is to stabilize the market, etc. But isn't there this entire target of increasing the prices and not stability? Isn't that something that they would prefer over stability? Because again, higher oil prices means higher revenue for the country. It's better for the government and the state and of course the wider economy. So would you say that they're actually abiding by that philosophy of theirs of stabilizing the prices and not chasing higher prices?
Yeah, I think very much that is the sort of official view or the official policy or the strategy from OPEC, is that they want to ensure market stability in terms of supply going out to the market, and then prices as a consequent factor on the back of that. But as you're right to point out, obviously higher oil prices do lead to a more comfortable fiscal position, more comfortable external balance of payments position for a lot of these economies. So when we look at the track record, certainly since OPEC has engaged in a lot more active market management in the last 2 years, I'd say actually their actions have been rather destabilizing towards the crude oil market. Because OPEC's tool is effectively how much it can produce or take off in the market. It is a very heavy-handed tool, so it can impact the market in a big way and also feed back into the local economies in a very significant way as well. So what we've seen this year is OPEC agree within their own members to cut production by about 800,000 barrels, and that's topped up by partners like Russia, Kazakhstan, to a total of 1.2 million barrels a day being taken off of the market. Now, what have we seen in terms of the price reaction in response to that? Yes, certainly we've had a recovery from where prices were at the start of 2019, but they haven't, in our estimation at least, gotten far enough away to break-even levels for a lot of the economies here in the GCC. So has that strategy been a success? Partly, but not entirely. And actually, you've introduced a new variable of uncertainty for the market. You know, how long do these cuts stay in place? How long can OPEC economies withstand the impact in terms of overall output and GDP growth? The more they take oil off the market, the longer they keep oil off the market.
Right. So again, I need to ask you. So when he said that, you know, how long are these production cuts going to be in place? Do you expect that to stay, or the production cuts to remain for the next 5 years?
Hard to say. Obviously, the decision is made to continue with the cuts for anything between 6 and 9 months. Now, I mean, just building on the argument Ed was making, it's changed a little bit. This process for OPEC has changed because although, you know, on the back end they do need the higher oil price, in reality it needs to become a balancing exercise, because they cannot force the hand of other producers to increase production. Therefore, they cannot, to a level, they cannot push prices towards 100 again, because that obviously unlocks new production elsewhere. So it becomes a bit of a vicious circle situation. But for 5 years, I think it's hard to say, obviously. But the issue has become that the market now kind of anticipates these cuts, and then OPEC has in a way become a little bit softer in recent years. We've seen a bit of a strategy change. I mean, in the early parts of the price collapse towards 2014-15, we saw a Saudi Arabia that was much more insistent in not cutting production, because obviously they were in view of the fact that cutting production will offer a lifeline towards other producers.
Yeah.
But obviously this has changed, and OPEC is as Edward was saying, is listening more to the markets and is aligning more towards the requirements for stability in prices.
That's the thing, right? So when we're talking about 800,000 barrels of production cuts, and then there's also news that we've seen about the neutral zone, which is again Saudi and Kuwait, which had been stopped for the last 4 years, if I'm not wrong, and now there are talks about production happening there, which is again equal to 500,000 barrels. So how exactly is this productive? Isn't this counterproductive to that argument then?
Yeah, it's certainly, those announcements relating to the neutral zone did come at an odd time, basically very soon soon after the OPEC Plus decision to extend production cuts into the first quarter of 2020. So whether or not that production is intended to replace depleted production in other parts of Kuwait and Saudi Arabia, that would allow it to come into the market and not be accretive in terms of its impact on market balances. But if simply they were to add another 500,000 barrels a day onto this market, this is not a market that could withstand that and keep prices for at least the Brent price in a sort of $60 to $70 kind of range. I mean, the reason we have OPEC oil prices where they are now, holding around, say, $64, $65 a barrel, is not because OPEC has been cutting 800,000 barrels a day, it's because they've been cutting significantly more than that. Countries like Saudi Arabia are cutting significantly more than they are required to do as part of the OPEC Plus agreements. So you can imagine if they were hitting their target at 100%, then the oil price would be considerably lower than where we are at right now. And let's not forget that they've also had the benefit of production being disrupted and interrupted in places like Venezuela and Iran, both of which are under U.S. sanctions. So their crude faces a much more difficult time going out to the market. And actually, when you look at on a year-on-year basis, most of the decline in production from OPEC countries in 2019 has come from those two producers, not from Saudi Arabia or for the UAE, which have actually been producing at a higher level year on year than they were in the same place in 2018.
Right, and so, but initially the argument for why the production or the entire neutral zone agreement was cut was environmental reasons. So isn't that still a concern now then?
It could very well be. I mean, the clarity over why the production was shut in the neutral zone several years ago was never very clear to the market, never articulated in a very clear way, coming at a time when oil prices were declining. I think most of the market could have sort of read between the lines as why you'd want to shut down that extra capacity. Possibly there is space for the quality of crude grades that come out from the neutral zone to replace the kind of heavier sour grades that countries like Iran or Venezuela had been producing and had been ones that had been favored by the refineries in Asia. So there is sort of scope for that kind of crude to be replaced. But let's not forget that these refineries that we see in places like India and China are among the most sort of sophisticated and technologically capable in the world, so they're able to take a wider range of crude inputs. So not only being reliant on the kind of crude grades that come out from the Middle East, they can also look to the United States as a new producer, a new exporter of crude. I mean, it's a very interesting figure to watch the level of just straight crude exports going out from the United States, which in some weeks can be about half of what Saudi Arabia exports.
Right.
There's a tremendous change in the way the oil market sort of analyzes itself, where you have what has been traditionally the biggest consumer, the place where everybody would dump extra oil if you didn't know what to do with it. You could say, well, the U.S. would always consume it.
Yeah.
Now that role has been reversed.
Now they're producing
the United States is a big producer and exporter as well.
Yeah, no, I mean, I think, and this is where data like exports comes very handy. Obviously, with the new production in a neutral zone, I mean, this will reflect on the exports. Obviously, in the end of the day, it's the Organization of Petroleum Exporting Countries. You know, the market gets a bit too hung up with the production levels, whereas the actual supplies to the market are at the export levels, right? And interestingly, I mean, in the latest round of cuts, we've seen exports being generally in line with the production cuts, so coming off a little bit. Not something we saw in earlier years. Especially for countries like Iraq, let's just say. That said, yeah, I mean, the US nowadays is at par with the UAE, practically just below or around the 3 million barrel level. So export-wise, this grades has been a bit of a vacuum situation for medium and heavier crudes because of Venezuela and Iran. So there's appetite for this kind of crude, especially for sophisticated refineries that can utilize this crude to the maximum and maintain their margins at slightly higher levels.
Right.
That said, there's a lot of in a way experimentation with lighter crude that the US is exporting, or a lot of the Far East countries like Japan and Korea are buying the US crudes because they want to feed their petrochemical industries as well. And
so you're suggesting there are new players entering the market then?
No, I mean, the U.S. has been gaining market share in the last few years, impressively actually. Obviously, a part of their exports was going to China before the trade wars started.
Yeah.
This has, kind of stopped now because obviously, within the context of the trade wars. That said, their exports overall, as a total, hasn't, taken a big hit on the back of that. They appear to stabilize around the 3 million barrel range. More or less, quite volatile still compared to Middle Eastern countries, where exports tend to be more stable on a weekly or a monthly basis. In the US, they're still quite volatile, but overall, if one is to average out through the month, that's roughly the level of exports in.
But also the geopolitical tension. I mean, of course, we're talking about the economic factors like demand, supply, export, import, etc. But then we can't really rule out what's been happening with the US sanctions, the attacks that have been happening, the US-China trade war. So what would you say, keeping all of this in mind, would be the major concerns for the next year?
Well, I think going into the end of 2019 and to at least the first half of 2020, some of those points you make about this escalation in geopolitical tension, that's probably going to be there as long as you have the Trump administration in power and seemingly no willingness to change their position about what their demands are from Iran with respect to its nuclear program and policies there. So that, let's say, floor, that bid from geopolitics remains in the oil market. I guess the question is how dominant of a factor that is in terms of setting prices. And at least in our view, when we can encompass that into an analysis of other variables and other fundamentals for the market, it's not in the driving seat right now. So other factors related to the trade war and the negative impact that has for global supply chains, for global trade volumes, and also just for general global growth, that's having a much more significant impact on oil demand and global commodity demand more broadly. So that's a factor that we don't see dissipating anytime soon. And you can see on a very short-term basis, oil and other commodity markets move in response to news that there is a chance for talks between China and the United States, or talks disappoint the market. So you see moves in prices on the back of that up and down accordingly. But that's something that is going to be very much more significant in our view in terms of setting the outlook for prices for the rest of 2019 and certainly into 2020. Is that trade war issue? We don't see it dissipating anytime soon.
So on this, in regards to there's a very big concern about market participants about how demand may soften, obviously partly on the back of trade wars, partly on the macroeconomic outlook. That said, the actual data is showing a bit of a mixed picture on this. Yes, there's been a bit of a softness in Asian crude oil demand, but part of that can be attributed into refinery turnarounds and maintenance. So it's the data itself is not fully supportive of this argument.
Right.
So in a way, the speculation in the market is obviously in the driving seat at the moment. It's just that. From an oil analyst perspective, it'd be interesting to see a few more supporting arguments and data on the back of that.
But Yorgos, couldn't the demand also be softened because there is an active push towards renewables? There's also a demand for replacement of fossil fuels right now. So do you see that as a factor to contribute to the fluctuations in the oil industry?
I mean, partly it will offset. I mean, there's no point denying that anymore. The world is heading towards different technologies to generate energy. Whether it's going to be an immediate impact or not, it's again, there's mixed views on it. I don't personally think there's going to be an impact on oil consumption patterns in the coming 1-2 years, just because of the electric vehicles or the renewables. In the long term, obviously, that's going to displace part of the oil consumption seen on the transportation sector, but that again is going to be contained within the private vehicles or perhaps trucks. It's hard to see renewables and electric vehicles displacing oil consumption in sectors like aviation and the maritime and shipping industry.
Right. I'm just going to bring the conversation back to the region a little bit and speak about companies like Saudi Aramco, there's ADNOC, etc. So Are you seeing this sort of hesitation when it comes to these companies investing in the sector more, which sort of needs to be done for the push that this region needs?
No, I don't think so. And certainly the big NOCs in the Gulf region do act as the kind of prime mover for overall economic growth. I think what we're seeing, beyond just the traditional role of, say, Aramco or ADNOC as being a straight upstream producer, so it produces and exports crude oil. There's been a transformation that we've seen, certainly the investment that we've seen into refineries and petrochemical plants across the region is part of that. So allowing for that company to kind of be hedged internally against moves in straight crude oil prices. But then also other ways to monetize the sort of assets or industry knowledge that these companies possess. So experiments that we've seen, experiments might be the wrong word, but innovations that we've seen in terms of ADNOC opening, let's say, its distribution arm to an IPO, or getting private investment into its network of pipelines, and also a move from all the GCC NOCs into trading in a more sophisticated and more organized manner, where there might have been a bit more experimenting in it in the past. This is more an effort to try and replicate, I think, what we've seen in the big private international oil companies, or even some of the trading houses themselves, to take advantage of their network and their knowledge in terms of meeting demand expectations, a lot of core markets. So just getting a little bit more value per barrel from all these companies. So there certainly is investment from these companies. It just might not be only in the traditional ways that we'd be accustomed to looking at it.
Right.
I think it's very important what you're saying in regards to the regional national oil companies looking more actively into the trading side of things. Let's not forget that the biggest earners in the oil market in the last few years have actually been the trading companies in the likes of Vitol and etc. Why is this? Because these are people that have a lot of knowledge in the market and the industry, and obviously they grab a margin, and the margin is there for grabbing in the end of the day. So this shift of the national oil companies going from more traditional suppliers, where they were exporting the oil more on a term agreement basis, into a more active trading sort of scene. Obviously, there's a lot of potential to increase profits.
And clearly, ADNOC moving towards IPO and being publicly listed was a great step that we saw in the last year. But now moving on to the price forecast for the coming years, so right now this year we've been seeing something between $60 to $65 per barrel throughout the year, and although there have been fluctuations within due to all the geopolitical situations, what do you have to say about the next year?
I don't expect a huge move upwards. Obviously, we lost nearly 3 million barrels a day from late last year to today, looking at Venezuela and Iran. And obviously, if that only managed to lift prices by a little bit, it's going to take a lot to go even further, especially with demand concerns in place. And the people that are putting the demand concerns forward in the market probably don't seem that they're going to be shifting their view on it. Mainly the speculators of the industry I'm talking about. So I don't expect a big move above 70 for Brent.
All right, brilliant. So in a lot of places, in a lot of countries in the GCC, they said that $70 per barrel is good enough to break even, considering what we saw in 2014, 2015. But my question is, how exactly are the people, the viewers who are watching us, the consumers, how exactly are they going to be impacted? We know with a higher price, the governments and the state is essentially benefited. But what's the direct impact we see? Because in the last few years, we've seen a lot of subsidies being cut. We've seen VAT being introduced. These are additional costs that have come with the reduced prices. Do you see that coming back again, the subsidies, coming back into the market once the prices have reached the peak?
No, I think once you've withdrawn subsidies, it'd be very hard to go back and introduce them from just a fiscal management and fiscal sustainability point of view to go back and to do something like that. I guess in terms of the impact it has for the kind of regular person in the economies here is, yes, higher oil prices should translate into higher government spending, and that would help support growth. But bear in mind, it's also worth keeping in mind that as you've reduced subsidies, that also means that your population should be exposed to the lower oil prices as well. So even if the government is not in its comfortable position, let's remind ourselves there's a lot more oil consumers out there in the world, not just in the GCC, but just anywhere in the world than there are producers. So even if you're filling your car up with petrol or diesel is a big input cost into your business, you should be on the benefit or the receiving benefit of those lower prices.
Right. Finally, my last question. Unfortunately, we're running out of time. Any new projects in the pipeline that could provide the right push for this industry in the region?
Well, I think certainly we see a big push towards upstream development or adding upstream capacity in a country like the UAE, also Kuwait, Iraq is another one. And it's important to bear these things in mind. These are going to be long-term projects. They're not ones that are fixated necessarily on the price projection for 2020. They might be more concerned about meeting overall demand in, say, 2025 and 2030. And certainly the pace of growth that we see in oil and energy consumption in the Gulf countries is very fast compared with pretty much anywhere else in the world. So simply in terms of just meeting the demand requirements for the region, certainly those projects are going to be helpful in terms of accommodating that growth.
Right, so this obviously comes with job opportunities in the sector then.
To a degree,
to a fair amount,
I mean, that's one of the, I think, issues for GCC countries more broadly is that, yes, you have this industry that can generate a lot of income. Yes, it's a volatile source of income, but when the times are good, the production costs here are quite low, so there's a lot of sort of margin or a lot of profit, if you want to consider it, for the NOCs in the region. But oil production itself is not very labor intensive.
Right.
It takes a lot of money to build a project, but once it's up and running, it doesn't need very many people associated with it. So in terms of the direct job creation that goes linked back to upstream production, it's not as significant as it might be in terms of the proceeds of that export and that production going on and spending on other construction or retail projects in the region.
And let's keep in mind that this is highly, specialized jobs. It's not the average job that a person just can apply for and get it. You need very specialized people. And in regards to projects, I'd like to add the big push the region is making towards the refining sector. I think that's a very interesting one and something that globally the oil market is definitely taking notice of. And again, it will maximize the amount of margin that the producers can sort of monetize in a way, and can equally contribute a little bit towards the labor market, I guess.
All right, great. Thank you so much for those valuable insights. We've definitely learned more about the Middle East oil sector and oil and gas industry. And thank you for watching AB Live. We will be back again next Tuesday.